Welcome students to the second video on valuations. In the first video, we looked at basic valuation concepts and also some myths underlying valuations. We also looked at how to value bonds and debentures and preference shares using discounted cash flow methods. In this video, we'll be looking at how to value ordinary equity using price multiples. So when we look at ordinary equity, we need to understand that often ordinary equity is more difficult to value than bonds or preference shares. And the reason for this is that ordinary equity, if you think about how to value ordinary equity, we want to take the future cash flows that the ordinary shareholders will get and we want to present value these. But what are the future cash flows made up of? The future cash flows will be made up of dividends, and often dividends and earnings are uncertain. This is often based on the economy of a company or the industry in which the company is operating. So dividends are not fixed, and this makes it difficult to predict or estimate what the future cash flows will be. Another reason why ordinary shares are more difficult to value is that companies do not have a maturity date. They are assumed to exist into the foreseeable future. They have an indefinite life. So the dividends are expected to be received by the ordinary shareholders indefinitely. Once we have estimated our cash flows, being the dividends, we now need to present value this. We will present value these cash flows by using the cost of equity or the WACC. And another reason why it is more difficult to value ordinary equity is that the cost of equity and the cost of capital are subject to greater uncertainty and they are more difficult to obtain than bond yields. When we valued bonds, we saw that it was quite easy to obtain bond yields for similar bonds, but this is not the case for equity. There are various methods that can be employed when valuing ordinary equity. If we look at the dividend discount model, this is a minority valuation method, and we will use this to value shareholdings that represent minority holdings. We also can use the price multiples method to value ordinary equity. This can be used either for a minority holding, or it can also be used to value a controlling interest, provided the appropriate adjustments are taken into account. We also have the free cash flow method. This is mostly used when we are trying to value a controlling interest. However, in rare cases, it can be used to value minority holdings, but an appropriate discount will need to be made to reflect this in the equity value. The EVA model can also be used in the same way that the free cash flow model can be used. It will be used to value mostly a controlling interest, but in some rare situations, it can be applied to value a minority holding. Then we also have the asset-based or net asset value model. This would be used mostly where a going concern risk exists. When we perform valuations, often more than one method is applied, and the reason for this is that the various methods can be used as a reasonableness test. For example, if we perform a valuation using the free cash flow model, this is not the only model we will use. Often we will also use the price multiples method to value the company, and in doing so, we'll be able to see the different values that the different methods give. And then once we have performed the valuation using the different methods, often there will be a range that the value of equity can fall between. And then based on the negotiations of the various parties, an amount will be agreed upon somewhere in the range. So in this lecture, we are going to focus on valuing ordinary equity using the price multiples method. Now you should remember this from your previous undergrad studies. However, we are going to go more in detail this year, so it's very important that you apply yourself when performing price multiples valuations. So what are price multiples? So this is a multiple that expresses the number of times the value exceeds some reported accounting item. So commonly used multiples that you will be familiar with are the price earnings ratio, which is the price per share over the earnings per share. So if we think about the price per share, this will come from the latest share price, which will be available for publicly traded shares. If we want to obtain the earnings per share, we can often obtain this from the financial statements, as this will be reported for the continuing operations. Then we also have EBITDA or EBIT multiples. The EBITDA multiple stands for earnings before interest, tax, depreciation, and amortization, and can be calculated by taking the enterprise value divided by your EBITDA. Then if we want to calculate the EBIT multiple, this is your earnings before interest and tax multiple. We can calculate this by taking the enterprise value divided by your earnings before interest and tax. Then we have the market to book ratio, and this is calculated by taking the latest share price and dividing that by the latest reported book value per share. The latest share price again will come from market information if the shares are publicly traded, whereas the book value per share you will be able to obtain from the financial statements. Then we have our price to sales ratio. This can be calculated by taking the latest share price divided by the latest sales per share. The last two multiples are important, and you can read about those further in your textbook. So price multiples are going to be used in valuations for both listed shares and unlisted shares. So we can use the PE multiples method when we are valuing listed shares to assess if there is possible over or undervaluation. And for unlisted shares, we can value unlisted shares by obtaining a listed PE multiple of a similar company and then performing certain adjustments to take into account differences between our listed company and our unlisted company. Like I said earlier, the various valuation models are not going to be performed in isolation. Often we will perform a price multiples valuation as a reasonableness test to other valuation methods, such as the free cash flow method. So the price multiples can be used to estimate the value of unlisted shares, and it can also be used as a reasonableness test of other methods, such as your free cash flow method. So let's look at an example of how to use the PE multiple method when we are trying to value or assess possible over or undervaluation of listed shares. In our example, we have three companies that are operating in the food and drug retail sector. These PE ratios were recorded on the 5th of May 2017. So we can see Pick n Pay has a PE ratio of 25.37, ShopRite has a PE ratio of 21.83, and Spar has a PE ratio of 18.16. Before we can assess whether there is possible over or undervaluation, we need to understand what do these PE ratios actually mean. So if we look at Spar's PE ratio of 18.16, this means that investors are prepared to pay 18.16 times the firm's earnings per share. And the next question we want to ask ourselves, is Pick n Pay overvalued and Spar undervalued? How will we assess whether Pick n Pay is overvalued and Spar is undervalued? To assess whether Pick n Pay is overvalued and Spar is undervalued, it is necessary to calculate the sector's average PE ratio. So if we calculate the average of this sector with the information we have available, we will get a PE ratio of 21.78. So from this, it can indicate that Pick and Pay is overvalued and Spar is undervalued, but it is not that simple. There are various factors that drive these PE ratios. So companies that have high growth rates in earnings will normally have a high PE ratio. But companies who have high levels of financial leverage may have lower PE ratios, which will reflect the higher risk profile of such companies. So yes, companies which have high PE ratios may indicate that the company's share price is overvalued. But yet, a high PE ratio may also indicate that there are low reported earnings per share for a particular year. So if you think about what the PE ratio is, it is your price per share over your earnings per share. So if your earnings per share suddenly drops unexpectedly, then yes, your PE ratio could suddenly increase. And eventually, this fall in earnings per share will reflect in the share price. But initially, the drop in earnings could be unexpected. So, for a few days, you could have a very high PE ratio until the market reacts. So, that is how to use the PE ratio when looking at listed shares. So, now let's move on to valuing unlisted shares using PE ratios. There are two multiples we can use to value unlisted equity. We can use the PE multiple method, which is a direct valuation method. So the PE multiples method will value equity directly. How do we determine the value of unlisted equity using the PE multiple method? We will estimate the latest maintainable earnings per share, and we will multiply this by the adjusted listed PE multiple, and this will give us the estimated value per share of our unlisted equity. So let's just unpack this formula. We need to obtain the company's latest earnings, and we need to assess various things about those earnings to make sure it is maintainable. And then once we have done that, we can obtain a listed company's PE multiple that is similar to our unlisted company. And we will adjust the listed PE multiple to take into account differences between the listed company and the unlisted company in financial risk and business risk. So often a listed company will have a different financial risk and business risk to the unlisted company. So if we are taking the listed PE multiple to value an unlisted company, we need to adjust the listed PE multiple to be reflective of the business risk and financial risk of the unlisted company. Once we have done that, we can take our latest maintainable earnings that we have calculated, and we can multiply this by the adjusted listed PE multiple. And this will give us an estimated value per share of unlisted equity. Please note that this is an estimated value, and often the adjustments that take place to the listed PE multiple are judgmental. Then we have the Abit and EBITDA multiples method. This is an indirect valuation method in that it does not value equity directly. It actually values the enterprise value, and then to get to the value of equity, you need to subtract the value of debt. So to calculate the enterprise value, we will need to obtain the latest maintainable earnings before interest and tax, and then we will need to multiply this by the adjusted listed EBIT multiple to obtain the enterprise value. Once we have obtained the enterprise value, we can get to the value of equity by subtracting the value of debt. To use the PE valuation method and the EBIT or EBITDA method, both of these require a calculation of the latest maintainable earnings. So in this slide, we are going to look at how to calculate the latest maintainable earnings. So what does it mean when we say maintainable earnings? This means we have to look at the latest earnings. So we are dealing with historic earnings, not future earnings. Another thing we need to think about is the earnings we get from the financial statements. Is this sustainable? There could be amounts in various years that are non-recurring, once-off items that should be subtracted if we want to calculate the maintainable earnings. So which earnings level are we looking at? And this depends on the multiple used. If we are doing the PE ratio method, then we want to obtain the earnings that are attributable to the ordinary shareholders because it is a direct valuation method. But if we are using the EBIT or EBITDA method, then we want to obtain those earnings level. So here we would want to obtain the earnings before interest and tax, or if we are using the EBITDA method, then earnings before interest, tax, depreciation, and amortization. So how are we going to determine the latest maintainable earnings? We are going to look at our historic earnings and we are going to adjust our historic earnings for items that are considered to be not maintainable. In most cases, when we are trying to calculate the latest maintainable earnings, it is not appropriate to use forecast earnings unless a forward multiple is used. Most of the multiples that are used are historic, meaning we need to use historic earnings when we are using historic multiples. And one could argue then that we are not taking future growth into account if we are using historic earnings. But remember, we are going to make an adjustment to the listed multiple for comparative growth that we expect to take place in the future. So what adjustments are we going to make to our historic earnings? We are going to adjust for items that are not representative of future earnings. Here we could have once-off items like a tax penalty. We are also going to adjust for items that are distorting the earnings trend. So remember, our starting point is going to be our reported historic earnings, usually for the last 5 years. And then we are going to adjust for non-recurring items. So what is a non-recurring item? This is something that happened in the past that is not expected to happen in the future. For example, if a company had a discontinued operation of one of its segments in the past, and this is not expected to take place in the future, we need to strip this out, because if we leave it there and we are valuing our equity using historic figures, then we will get a value for equity that is not going to be accurate. We also need to adjust for non-recurring income or expenses. For example, we could have received damage insurance compensation if there was a flood, and if we expect there to be no flood in the future, then we need to strip out all of those amounts relating to the flood, as this would have had an impact on our earnings. It is possible that a company could have had restructuring costs in the past, and if it is not expected to restructure again in the future, it doesn't make sense to keep those restructuring costs. You need to strip it out, as these restructuring costs are not expected to happen in the future. We also need to adjust our historic earnings for non-arm's length transactions. These are items like an excessive salary. If someone in the company is a relative and is receiving a higher salary than other people doing the same job in the company, this is a non-arm's length transaction and it needs to be brought to the market value. There could also be situations where the company is being charged a soft interest rate because it has taken a loan from a related party. In this situation, if the interest rate charged is not reflective of market interest rates, We want to adjust for that because it is a non-arm's length transaction. We are also going to adjust for unconventional accounting policies. If a company is applying an unconventional accounting policy, for example, with regards to depreciation, then we need to adjust for that, as it would have an impact on our earnings. We also need to adjust for items that are distorting the trend analysis. There could be various over or underestimates like audit fees and taxes that need to be adjusted to reflect what is going to happen in the future. And if there have been changes in accounting policies during our historic period, we need to restate those years before the change in policy. If a new accounting policy has been implemented during one of the years we are looking at in our historic earnings, we need to restate all of the years before the change happened in the accounting policy. We want all of the historic earnings to reflect the new accounting policy because this is what is going to happen in the future. The old policy is not representative of what is going to happen in the future. So we need to adjust the earnings and account for all years as if the new accounting policy was in effect. Once we take all of these adjustments into account, we will get something called our adjusted earnings. And this adjusted earnings will be used to calculate our value of equity using our multiple. And this adjusted earnings will be multiplied by our multiple to obtain the value of the enterprise or the value of equity. Once we have calculated our adjusted earnings for our historic period, we can look at those earnings and assess what the trend is in those earnings. Because the formula uses the latest maintainable earnings, we need to assess what is the trend in the historic period and are the latest earnings maintainable. So when we're looking at the trend analysis, we want to see, are there any significant changes in operations? If there have been significant changes in operations, then we need to look at those years during our historic period in which those changes took place. And then when we are calculating our maintainable earnings, we will calculate an average, but we will give a greater weight to those years in which the changes were implemented. For example, if we have new management that started 2 years ago and our historic period is 5 years, when we want to calculate our maintainable earnings, it makes sense to calculate an average and give greater weight to the years in which the new management were working at the company. If we look at our adjusted earnings and we can see that there is an upward trend in growth in our earnings, then this suggests that the latest year is maintainable, and this is the year that can be used when we are calculating the value of equity. If we look at our earnings and it is erratic, 1 year it increases, 1 year it decreases, this suggests that a weighted average of those earnings may be appropriate when calculating our maintainable earnings. If we look at our earnings and we can see that there's a downward trend in earnings, this could suggest at best that our latest could be used, but it is important here to interrogate future prospects. If we look at our earnings and there's a downward trend in our earnings, this could be worrying and it could suggest that the latest earnings is not maintainable. Here, it would be important to interrogate the future prospects and to look into the future and to look at the forecast and perform a SWOT analysis. What do the future prospects say? Do the future prospects support the latest maintainable earnings? If they don't, then it will not be appropriate to use that. If they do, then you could use the latest maintainable earnings with caution. So the earnings trend analysis we have just discussed is going to be based on historic figures. But what happens if there is going to be expected growth in the future? The future growth rate will need to be estimated, and this can be estimated by looking at the historic trend and also the future prospects of the company. Once it has been assessed what the future growth rate is estimated at, we can compare this growth rate for the unlisted company to the growth rate for the listed company. And if there is a difference between these growth rates, then it will be appropriate to adjust the listed multiple. So now that we have discussed the various adjustments that need to be made to the earnings, let's have a look at an example of how to use the PE valuation. In our example here, we have a company called Pty Limited. This is obviously an unlisted company, and they operate in the food and drug sector. Its controlling shareholder wants to sell. What price are you willing to pay for the shares? And here they give us a whole lot of information about Z. So Pty Limited has superior growth expectations because they have a strong rural presence. Z is much smaller than the average sector listed firm. The latest maintainable earnings per share is 5 Rand, and the average PE of similar listed firms is 20. So the market is paying 20 times the latest earnings per share on average. So the question here is, are you willing to pay 100 Rand per share? So we want to perform a valuation of Pty Limited and assess, are we willing to pay more than 100 Rand or are we willing to pay less than 100 Rand? Let's have a look at the things we have just learned and calculate the equity value of Pty Limited. So the question gives us the latest maintainable earnings per share. So there is no adjustment that needs to take place here. We do have to decide how we are going to adjust the multiple. So remember what I said previously, in order to calculate the equity using the PE valuation, we need to take the latest maintainable earnings per share and we need to multiply this by an adjusted listed PE multiple. This question provides the latest maintainable earnings per share, and it is 5 Rand. But we have only been given the PE multiple of a similar listed firm, and there are likely to be differences between this listed firm and Pty Limited. So we need to make a number of adjustments to this PE multiple of 20. So our first point in valuing Pty Limited is going to be obtaining a similar listed PE ratio. And in the question, they told us that a similar listed sector average PE ratio is 20. Then we need to make certain adjustments because there are differences between the financial risk and business risk for the listed company and for the financial risk and business risk for Pty Limited. There will be differences, so we need to either increase the PE ratio or decrease the PE ratio based on those differences. So if we think about the PE ratio we have been given of 20, this reflects the PE ratio of a listed company. A listed company shares is a lot easily more marketable than an unlisted company. Because we are using this PE ratio to value Pty Limited, we actually need to discount or decrease this PE ratio to show that Pty Limited has less marketability than the listed company. So we are going to decrease this, and we have decreased it by 25%. Then in the scenario, they told us that Z is much smaller than the average sector listed firm. So again, we need to adjust this listed PE ratio because it is for firms that are a lot larger than Pty Limited. So we are going to decrease the PE ratio to take into account the fact that Pty Limited is smaller than the listed companies. And we are going to adjust this down by 25%. Often there are higher rates of corporate failure in smaller companies than there are in large listed companies. So we are going to simply adjust for this risk. There could also be specific risk factors that we are told about the company that need to be taken into account. For example, Z could have weaker BEE than the listed companies. They could also have only one experienced manager, where the listed companies could have a few experienced managers. So if these specific risk factors are told to you in the scenario, then you will also have to adjust your listed PE ratio. So we are going to adjust downward because Z has weaker BEE potential, and also they are depending on a key manager, whereas listed companies will have more experienced management. So we are going to adjust the PE ratio downward for this specific risk factor. Then we are told in the question that ZPTY Limited has superior growth expectations. So it has higher growth expectations than its listed counterparts. So we can actually now increase the PE ratio because ZPTY Limited has a higher growth potential than other listed companies. So here we will increase the PE ratio by 10%. Then when you think about the PE ratio, what is it actually telling you? It is giving you the price per share over the earnings per share. So this is for one share. So this is actually reflective of a minority shareholding. But we are told in the question that we are valuing 51%, meaning we are actually valuing a majority holding. So to take into account that the PE ratio is reflective of a minority holding, but we are valuing a majority holding, we need to add a premium for control. Once we have made all of our adjustments to the listed PE ratio, we will obtain an adjusted fair PE ratio for ZPTY Limited, and this can then be multiplied by the latest maintainable earnings per share of 5 Rand, which was given to us in the scenario. So this will give us a price per share of 70 Rand. So as you can see, we are not willing to pay 100 Rand per share, whereas the likely value of ZPTY Limited is closer to 70. Now, one of the questions you may have is, how do we know how to quantify all of the adjustments that we are making to the PE ratio of the listed company? So these adjustments are actually judgmental and require professional judgment when made. My suggestion is to look at various sources out there, such as surveys that are performed by the Big Four accounting firms, to determine which adjustments are appropriate. We can also look at recent ITC exam papers to assess how to quantify these adjustments. We will go through a few sources on how to quantify these adjustments, but remember, it is judgmental. There is no one correct answer. As long as your answer falls within that range, then you are likely to get an accurate estimate of your equity value. So like I've mentioned previously, we are going to take the listed company and we are going to make adjustments for various differences in risk factors and growth potential between the listed company and the unlisted company. As you saw from the previous example, these adjustments when quantified are very subjective, but there are some guidelines we can use to assist us when quantifying those adjustments. The first adjustment we are going to look at is when we are discounting for lack of marketability. So a listed company has shares that are very marketable, and it is easy to sell these shares, whereas an unlisted company, often it is not easy to sell those shares. So we have to make an adjustment for this. Often when we quantify this adjustment, we need to look at the size of the stake we are valuing. So if, for example, we are trying to value a shareholding that is less than 25%, in the past adjustments have been made that average 17% when we have a holding that is less than 25%. Whereas if we have a holding that is in the range 75% to 100%, then in the past the adjustments that have been made average to about 8%. So when we look at the PwC source, majority of analysts in the past actually applied the discount to the final equity value, but it has the same effect if we apply it to the multiple or the final equity value when we are using the PE multiple method. If we look at other research data, such as SASL and research from the US, adjustments made often fall in the range from 20 to 30%. If we look at sources such as the ITC exam and the ITC past papers, they usually adjust for the lack of marketability using 25%, regardless of the stake. So regardless of the holding, whether you're holding 40% or 80%, they will adjust by 25% to take into account the lack of marketability. So when we are valuing our unlisted company, we will need to assess, is our unlisted company smaller than other listed companies, or are they larger? In most cases, unlisted companies will actually be smaller than their listed counterparts. So smaller companies will often have a higher rate of corporate failure. So when we are valuing our unlisted company, if it is in fact smaller than our listed companies, then we need to adjust for this fact. So often, the rate of corporate failure is higher in smaller companies because they have less access to finance, and this is because they are unlisted or they have less collateral or property to offer as security. Smaller companies are less able to withstand competitive pressure. For example, if there is a price war and other companies drop their prices, they may not be able to compete and still make a profit. Smaller companies are also more vulnerable to changing market conditions as they have less of an ability to adapt. So if we look at our various sources, such as our PwC survey and our ITC guidance, we need to have a look at what they have adjusted for in the past. So in our PwC survey, we can see that if our unlisted company is substantially smaller than our listed company, an adjustment of between 30 to 40% has been applied to the multiple. Whereas if our unlisted company is only somewhat smaller than our listed company, the adjustment usually falls between 10 to 20%, and this was applied to the multiple in the PwC survey. But if we look at the past ITC papers, in the past, when this section was tested, if the company was substantially smaller than the listed company, an adjustment of between 15% and 25% was performed to the multiple. If the unlisted company was only somewhat smaller than the listed company, an adjustment of between 5 to 15% was made to the multiple. So if we move on to other risk factors that need to be adjusted for, often the question will give you specific indicators that there is a specific risk that needs to be discounted. So if we look at sources such as our textbook on page 26 in chapter 7, so both the textbook and PwC survey, they actually adjust for these specific risk factors by adjusting equity as opposed to the multiple. But we'll have a look at that in more detail in chapter 15 when we look at cost of capital. So examples of these specific risk factors would be things like only having one experienced manager, so there is key management dependence. You are reliant on that manager for their experience, and if that manager decides to leave, then the company would have lost significant experience, and this may affect its operations and profitability going forward. The company could also have only one main customer or supplier, and this is risky because if that customer or supplier liquidates, the company may not be able to survive without them. The unlisted company could also be a relatively new startup company which has no past track record. In this case, it will be difficult for that company to obtain finance, and the company will not have an established customer base, so it will be more difficult for this company to be profitable. So for all of these items we have mentioned, if the unlisted company has any of these specific risk items, then we will need to decrease the multiple. There could also be factors that our unlisted company has that could actually be better than the listed company. So the unlisted company could have better liquidity, solvency, and they could also have better innovation than the listed company. So how are we going to adjust for this? Like I've said, the textbook and the PwC survey adjust the equity. If we look at the RTC as a guide, the RTC often adjusts in the range 5 to 10% for one of these specific risk factors, depending on the extent of the risk between the listed company and the unlisted company. If we are adjusting for any of these risk factors, for example, if the unlisted company is a startup company, we may want to adjust the multiple in the range of 5 to 10%. However, we'll want to take into account that we will be adjusting for the growth potential of this unlisted company. And often a startup company will have a low growth potential. So we just want to make sure when we make these adjustments, we avoid double counting. So we don't want to adjust the PE multiple downward here because it is a startup company, and then also adjust it down further because it has low growth potential in the future, because this could result in double counting for this risk, which would make our value of equity inaccurate. The next adjustment we need to talk about is the adjustment we often make for control premium. Like I said previously, when we look at the PE ratio, it is calculated by the price per share over the earnings per share. This basically reflects a minority holding. But often we want to value a majority holding. But if we are valuing a majority holding, perhaps there is going to be an acquisition, then we will need to adjust the PE ratio upwards to take into account that we are valuing a majority holding. This is known as a control premium. There are certain benefits that come from having control over a company through holding more than 50% of its shares. Some of these benefits are things like having operational control, also having a say in the dividend policy of the company. The shareholder that has control can also decide on directors' appointments, and they also will have to approve asset purchases and sales. So as a result of this benefit, if we are valuing a controlling stake, we need to adjust the PE ratio upward and add a control premium. So according to the PwC survey, this premium will depend on the extent of control. If we are valuing a shareholding that is between 51% and 74%, they say that most companies make an adjustment for a control premium between 15% to 20%. Whereas if the holding we are trying to value is between 75% and 100%, in the past, companies usually adjust the multiple between 20% and 30%. And we can also note from the PwC survey that the majority of analysts applied this discount to the equity value. However, this is different to the RTC approach, and the RTC approach actually makes this adjustment to the multiple. Another adjustment that often needs to take place when we are valuing unlisted companies is we need to assess, is the growth expected in the future for the unlisted company going to be different to the company that is listed whose PE ratio we are using? So a discount or a premium will need to be done to the multiple depending on whether the growth in the unlisted company is expected to be better than the listed companies, or the growth expected in the unlisted company could actually be lower than what is forecast for the listed companies. As we are looking into the future to assess the growth potential of the company, we actually need to consider, is the growth we are estimating, is it going to be feasible? Is it going to be accurate? Often there will be many new companies entering the market. So if a high growth has been forecasted, we just need to ask ourselves, is this growth actually sustainable? How will this growth be financed? Is the company going to be investing in new capital projects? Perhaps the company expects high growth because they expect sales to increase in the future. Here we would have to assess, have the orders been placed by customers? Is the growth expected going to be accurate? Another thing we can look at to assess if the forecast growth in the future is accurate is to assess what has happened in the past. If we have forecast growth of 20% in the future, but in the past the company has only grown by 10%, we would have to assess, is the growth of 20% expected in the future actually going to be accurate? So once we have compared the growth rate for the unlisted company to the growth rate of the listed company, and we can assess whether a discount or a premium needs to be made to the listed company's PE ratio, we need to quantify that adjustment. So if we look to the PwC survey, they actually make an adjustment to the multiple, but they do not give any guidance on how to quantify that adjustment. If we look at ITC sources, such as past ITC papers, they usually use an adjustment of between 5 to 20%. So the size of the discount or premium will depend on how the growth rates differ. If the growth rates between the listed company and the unlisted company are expected to be relatively close, then the adjustment would be smaller. Whereas if the growth rate for the listed company is much larger than the growth rate for the unlisted company, then the adjustment would likely be larger. So now that we have looked at all of the adjustments, where should these adjustments be made? So different sources will make the adjustments in different places. Some will adjust in the final equity value, where the other sources will adjust in the multiple. If we look at the PwC survey, some of the adjustments we discussed are made to the multiples, whereas most of them are applied to the equity value. If we look at the ITC examples, they adjust the multiples. So this is the approach we have taken in the TUT. If we are using the PE valuation method, whether the adjustment is made in the multiple or the final equity value, it should have the same impact if it is quantified accurately. So now that we have looked at the PE valuation method, let's move on to the Abit or EBITDA multiple when valuing unlisted equity. So how do we determine the Abit or EBITDA multiple? This can be determined by taking the enterprise value and dividing by your earnings before interest, tax, depreciation, and amortization. Or if you are trying to calculate your Abit multiple, you can divide the enterprise value by your earnings before interest and tax. Please note that this multiple method is an indirect valuation method. It does not value equity directly. It gives you the enterprise value, and then you can calculate the equity value from the enterprise value by subtracting the market value of debt. So if we look at an example here, we want to value 100% of XPTY Limited's equity. We are told that the maintainable earnings before interest and tax is 33 million, and the market value of X's debt is 24 million. They've told us that similar listed sector average EBIT multiple is 10. So we will obviously need to take the similar listed EBIT multiple of 10, and we will want to make various adjustments to take into account differences between the financial risk and business risk of the listed company and the unlisted company. They have told us here to assume that the adjusted EBIT multiple for the unlisted company is 7. So if we want to value 100% of XPTY Limited's equity here, how are we going to do it? If we go to the next slide, you can see here that we have taken X's maintainable earnings before interest and tax of 33 million, and we have multiplied it by the adjusted EBIT multiple of 7. And this will actually give us the enterprise value because it is an indirect valuation method. But remember, the required wanted you to calculate the equity value. So how do we get to the equity value from the enterprise value? We will need to subtract the market value of debt. So if we subtract the market value of debt, being 24 million in this case, we'll see the value of X's equity is 207 million. So one may want to ask, which is the better method, the PE multiple method or the EBITDA method? So there are various advantages to why someone would want to use the EBIT or EBITDA method. If we think about it, we are using our earnings before interest and tax. So any differences in financing policies between the various companies will be taken out. So there will be no distortions if the companies have different financing policies. Also, there will be no distortions from those items that are considered non-operating expenses or revenues. This would be things like investment income and investment expense. By using the EBIT and EBITDA method, it does not allow this distortion, which could take place if using the PE multiple method. Companies could also have different depreciation and amortization policies. So if we are using your EBITDA multiple, being your earnings before interest, tax, depreciation, and amortization, then the depreciation and amortization is stripped out. So this will not allow any distortions to take place. If we go on to our final slide for this lecture, now that we have looked at how to use price multiples when valuing equity, we need to consider what are the limitations of using this valuation method. So the first limitation we need to consider is that when we are using this valuation method, we are obtaining a multiple for a listed company and we are trying to value an unlisted company by using this multiple and making various adjustments that are considered necessary. Even if all the adjustments are made, often the company we are trying to value does not have a similar listed company. So often it is difficult to find similar comparable companies, and we often have to settle for a listed company that is close to our company but not an exact match. Companies will have various different growth potentials, different risk profiles, and they'll have different accounting policies, and we can do our best to adjust the multiple for this. It does lead to a lot of subjectivity and judgment in our answer. If we go on to the next limitation, we can see that if there's a temporary drop in earnings, this could actually result in an overstated multiple. So what this means is that if we think about our PE ratio, it is your price per share over your earnings per share. If there's a temporary drop in earnings, your PE ratio will actually go up, which makes the company look good. But in actual fact, this is a short-term increase. It is not reflective of what investors are prepared to pay for the share. Also, when using the PE multiple, if there are losses instead of earnings for a company, then you will actually get a negative PE multiple, which is meaningless and cannot be used when valuing companies. If you think about the first thing you learn in corporate finance when valuing securities, is that it should be based on the present value of future cash flows. As you can see from what we have gone through in today's lecture, the PE multiple method does not use discounted cash flows. Therefore, it actually violates the basic valuation principles. When calculating your maintainable earnings, one needs to assess what is the reliability of these earnings. Can we say because these earnings have taken place in the past that they are actually representative of the earnings that will take place in the future. So in most cases, the PE ratio we are using is the historical PE ratio, which means we have to use historical earnings. It is possible to use forecast earnings, but only when you have a forward multiple. Earnings could also be manipulated through smoothing, and this would have an impact on our equity value. And the last limitation is that the adjustments that are made to the listed multiple to value the unlisted company, these are very subjective, and there's a lot of judgment that is involved when quantifying these adjustments. So despite all of these limitations, price multiples are often used in practice. It is quick and easy to calculate, and it is well understood, making it a desirable valuation method. So this brings me to the end of the second video on valuations. Thank you for watching.